Joining Walker & Dunlop CEO Willy Walker live today is KSL CEO Eric Resnick. Willy and Eric will discuss navigating the pandemic, the future of skiing, golf, and other outdoor recreation, and where KSL sees growth and opportunity in travel and leisure investing going forward.
Thanks, Susan, and welcome everybody. As you can see, our setup today is a little different from the normal Zoom call, and I have to say I am absolutely thrilled to be sitting face-to-face with my friend Eric Resnick in his office in Denver to do this webcast. We, over the coming weeks and months, will figure out whether we stay on a Zoom format or whether we do more face-to-face. But I was down in Las Vegas last week and did an interview with the CEO of Mgm Resorts, Bill Hornbuckle, and it was great to sit across on the stage with Bill, and we are going to broadcast that interview in the next couple of weeks on the Walker Webcast. But Eric, thanks for joining me. It's great to be in your office, and it's fun to be seeing you face-to-face rather than over a Zoom call.
It's so much better.
It is so much better.
It's great to see you. Thanks for having me.
So let me do a quick introduction, and we'll dive into the discussion. Eric is the co-founder and CEO of KSL. Prior to forming KSL, Eric was an executive with Vail Associates, and prior to that, he was a consultant with McKinsey and Company. He currently serves as vice chairman of the U.S. Ski and Snowboard Foundation and is a member of IREFAC, which is the Industry Real Estate Financing Advisory Council, the World Travel and Tourism Council, and the Real Estate Roundtable, which we both are privileged to be members of. He also serves on the University of Colorado Cancer Center Advisory Board. Eric holds a BA with distinction in mathematics and economics from Cornell University. So let's back up to that Cornell. You're a senior in high school, trying to figure out what you're going to do and where you're going to go to college. Why'd you go to Cornell?
There's a debate in my family about the answer to that. So my answer is my parents went to Cornell. I always, it wasn't they. I didn't do what kids do today and travel all over touring lots of different schools. They went there. I knew it was a great school. I grew up in the Washington, D.C. area and thought it'd be a great place to go to school. And my girlfriend and I both at the time, and I both applied. And she got in, I didn't. I went to the University of Virginia for my first semester of college. And then when I was visiting her, I had been waitlisted and given something that said you could come your sophomore year if you had grades above a certain level. And I was visiting her that fall and loved the campus. Ithaca in the fall was beautiful, not so much in the winter, but and I really wanted to go there. And because UVA was an incredible school, but it didn't feel as different coming from Northern Virginia where I lived and grew up as going to a place like Cornell. And so I went to the admissions office and said I wanted to go, but I wanted to start in January, not the following year, but they wanted to wait if I was going to do it. So they said, okay. So I transferred. My girlfriend and I later broke up, but so my family tells me that I chased my girlfriend to Cornell. We were broken up when I went to Cornell, but anyway, it was, and then we got back together and stuff, so they tease me about that all the time. But I went to Cornell really because, they had a great math program, which I wanted to study at the time. And, I just really loved the place. And for me, it was kind of getting away from home and experiencing something different. But it was a great experience.
Given you're now so deeply into the hospitality industry, did you take any courses in their hospitality management?
No, that's the funny thing. No, I didn't. And, at the time, I would go to the Statler Hotel where the hotel school is. And I go for lunch. I had friends in the hotel school, and I just, majoring in math and economics at the time, and I didn't have a lot of excess kind of courses I could take. I regret it now, because I would have loved to have done some classes in the hotel school, but I never did. And I really want to take wines. I don't know anything about wine today, and they have this famous wines class. But you have to be 21 at the beginning of the semester to take it. And I turned 21. I graduated in December, so I graduated off cycle or whatever semester early. And I turned 21 in November, so I was never eligible to take the class. So I wanted to take that one in particular, but yeah, no, I never did. I feel like I went to the hotel school now.
Yeah,
right, most of the people I know from Cornell in the industry, they all did. But yeah, I did not.
So you leave Cornell and go to McKinsey. Why consulting? And were you in a certain practice group when you went into McKinsey, or were you just sort of a generalist?
So I went, I was a generalist. I was a business analyst for 2 years, and I didn't know what I wanted to do coming out of college. And today, a lot of the folks who join our firm and other firms like ours, it almost feels to me like they knew from high school that I want to get into private equity or real estate investing. I had no idea, and I just, I ended up at McKinsey because I was walking through campus one day at Cornell with a friend, and he was breaking off as I was going to my apartment. I thought, where are you going? So I'm going to an information session for this company, McKinsey. And I was like, oh, who's that? He said, oh, they're a pretty cool company. Why don't you come and listen? And I went and I listened into the session. I was intrigued by what they said about what they do, like working with world's leading companies on these challenging problems and team environments, getting involved in all aspects of a business. And I thought, oh, well, maybe I'll apply too. And so that year, he and I happened to be the two people from Cornell who were hired. And so I went to McKinsey, and I otherwise was probably going to go to law school or public policy school.
I had Bob Glazer on the webcast a couple of weeks ago, and he was talking about how expert McKinsey is at creating this alumni network, and that when someone wants to leave McKinsey to go into industry, they almost not only promote it and help you do it, but kind of give you all the resources you need to either start up a company or go into it. Do you, as a McKinsey alum, does KSL or your portfolio companies use McKinsey a lot because you've got sort of McKinsey in the back of your mind?
So it's funny. We do now. And Denver is one of the fastest growing offices for McKinsey, which I get a kick out of. The Denver office is 3 times the size of the Washington, D.C. office, which is where I was at the time. And Denver didn't even exist then. Denver, I think, started in the last 10 years. And so, I don't think we hired them because of that connection, though. There's a certain amount, I think it's pretty cool. The alumni network thing is really powerful, though. I still get calls today from recent McKinsey alums asking for career advice because they find my name on the alumni website. Right. And I always admired, I think about this whenever people have gone on and left our firm, even though it's not quite the same, that, at McKinsey, every alum is a future client, right? I think is their attitude. And they treat their alums incredibly well. Continuing education, inviting to seminars. They invited me to go on an office retreat, a year after I left the office. And I always think about that as it's a small world. And, and these are people-oriented businesses. And so, that alumni network can be really powerful. So I think it's great for culture, for the firm, but it's also great for the business. So we've tried to mimic that in our own way.
Were you working on something with Vail when you decided to leave McKinsey and go to Vail, or what was it that took you from McKinsey to Vail?
Yeah, there was a guy who's sadly since passed away, but he was a senior director at McKinsey who was in the Washington, D.C. office with me. And everyone kind of knew this because, maybe I'll explain the story, but he had done a pro bono study for the U.S., what was at the time, I guess, the National Skiing Association, I guess it still is, about how to grow a flat sport, meaning skiing. And I grew up skiing, loved skiing. I wasn't necessarily very good, but I was passionate about it. What my family did, every year we take a 1-week ski trip. And so Terry his name's Terry Williams, he had a case study that he used for training for McKinsey managers using the ski industry pro bono work that he did, because it was kind of fun and interesting to people. And so I knew he had done that. And so we would talk about it in the hallway. And one day when I was kind of 2 years in, and it was a 2-year program, so you're starting to think about what do you do next? He said, what do you think about doing? And I said, I have no idea. And he said, have you ever thought about combining your vocation with your avocation? And I looked at him. I said, what do you mean? He said, well, you love skiing, right? Said, yeah. Why don't you get a job in the ski business? I was like, there is a ski business? What is that? What's the ski business? He said, yeah, well, look, I know some people from the study I did, which was in the mid-'80s, and this is now the mid-'90s, right? So 10 years removed. He said, I'll put you in touch with a couple people. So he did, and that led to me going to Vail. So there was a McKinsey connection, but not because, there was a study or anything bad being done for Vail. That, his advice led to me talking to a fellow who, at the time, owned Press Review, and he put me in touch with Andy Daly, who at the time was the president of Vail, and they ended up hiring me. And so that's how I got to go.
So I want to loop back to Vail, but I've got just a quick McKinsey senior partner story, which was that when I was graduating from business school, I got an offer from McKinsey, and they said, what office do you want to go to? Which, as you know, is somewhat unique because they kind of give you offers from offices. And so I flew out to San Francisco, to the McKinsey San Francisco office, and went to hang out with a bunch of people who graduated from HBS the year before, and it was nice and what have you. And so I got into the elevator, and this, at that time, to me, older man, probably about
probably our age now, right?
Exactly. And
young guy. So young guy.
Exactly, young guy. He gets on and he says, so how'd it go? Thinking that I was interviewing, and I was, oh no, I've got an offer from you. I'm just trying to kind of kick the tires on the office. And he said to me, so what are you trying to figure out as far as what you're going to do? What other offers do you have? And I said, well, I've got some other consulting offers. I've got some banking offers. I've got some industry offers, this and that. He said, I got a question for you. Do you get the Sunday New York Times? I said, I do. He said, what's the first section you read? I said, front page. He goes, what's second? I go, business. He goes, what's third? I said, probably style. He goes, what's fourth? I go, outlook. He goes, do you ever get to the crossword puzzle? And I go, no, I hate crossword puzzles. And we're going down in the Transamerica building in San Francisco. This is all happening in the elevator. And he looks at me and he goes, you look like someone who likes to do things. Don't be a consultant. Go do something. And the doors opened up, Eric. He walks out and heads his way. And I literally called McKinsey and Bain and said, thanks, I'm not coming to you to go consult.
And who, but you know who he was in there?
So a number of McKinsey people have told me who he is. He's some iconic partner in the San Francisco office. Some people who work there have told me his name. I don't remember his name.
That's interesting.
But
so it was a senior partner basically convinced you not to go.
Not to go. But what an, I mean, and honestly, it was wild how he kind of assessed me just going down the elevator.
Literally the elevator pitch, right?
You got it.
That's
so
great.
You joined Vail. Were they owned by Apollo at the time?
They were.
They were.
Yeah.
So you were going into sort of a, if you will, a leverage buyout at that time.
Yes, which with hindsight is great. You know, it was a great experience. I had no idea.
Right.
You know, I was completely ignorant. And so I went, and I'm guessing I didn't realize Apollo was involved until I actually started the job. Yeah. Maybe in between interviewing and starting.
And was Adam Aaron there as the CEO at that time?
Not quite. So I started in May, and I thought it was really cool, or late April, and they put me up at the Hyatt in Beaver Creek for 2 weeks. I'm like, oh, it's great. I was skiing and stuff. Little did I know, Beaver Creek closed the weekend before. Everything in Beaver Creek is closed. I got a nice room at the Hyatt, but that was all I had. So I started in like late April and May. That's why I remember that. And Adam started in July. So he was just coming on board, and the first week we started working on the acquisition of Keystone and Breckenridge, that ultimately kind of formed the basis of what Vail Resorts is today. And then we went public the next year. So I started working closely with Apollo on the acquisition and then ultimately the IPO and that. But so Apollo was involved, but I really didn't know it going there.
And you ran strategic planning as well as investor relations. So you got a good sense while you were there, both from how are we growing this enterprise and M&A, and then also on the IR side of taking the company public and managing with investors?
Yeah, and the other thing I had was operational finance, or what we call FP&A today, financial planning and analysis, so budgeting, forecasting. And that was actually, in some respects of all that I did, that was the most valuable to me. Because I learned, how does a business actually work, right? What are the challenges associated with running, ski schools, retail, hotels, the ski mountain itself, the golf course, or whatever it might be. And so that was actually probably more valuable to me than working with Wall Street and doing the M&A and strategy stuff.
So what was it that got you and Mike Shannon to think about starting up a private equity firm that was focused on travel and leisure?
Well, so in between those two things, what happened was Mike called me, and I had known about Mike because Mike was the president of Vail Associates from 85 to 92. I was there in 96 to 2000. He called me and asked if I'd be interested in joining KSL as a CFO. And KSL was part of KKR at the time. It was a portfolio company of KKR. And that at that point, I knew that.
Now you understood what private equity was.
I mean, only a little bit. I mean, but a little. And I knew enough to read Barbarians at the Gate before I had to interview with Henry Kravis, which shows you how small KKR was, because at the time, Henry had to interview me as a CFO of a portfolio company. That certainly would happen today, I'm sure, appropriately so. But so Mike called and I joined. Ultimately, it led to me joining KSL with Mike as CFO. And it was early 01, January 01. And then we kind of continued to build up that platform, sold most of our assets in 04, 05. And it was then that Mike and I thought about, okay, we've had a successful, at that point, 12-year run for Mike with KKR. And we thought about, do we want to kind of re-up and do this again with KKR, or do we want to do something different with ourselves? And a few outside advisors and a few of the folks, including our CIO now, Peter McDermott, who lives across the street from you, we're kind of advising, look, you guys could raise your own fund And we had gotten to know some of KKR's large LPs through hosting their annual meetings, because we had these large resorts, we host the annual meetings. And so we talked to a couple of those LPs, and they said, yeah, we'd be interested in backing me. So that gave us the confidence to raise our own fund. That was 05, 06. So, we'd always done travel, leisure, recreation, right? Mike came out of Vail, 5 years before I came out of Vail. Then we did golf resorts, we did beach resorts, with KKR. And so we had kind of developed this operating expertise, and investment expertise. And that was what was unique about us, is our heritage was operations, right? We didn't come at it from having been on Wall Street. Neither Mike or I, ever worked on Wall Street. And then we were operators in the ski business, so to speak. And so we started with that, and then we became investors. We kind of vertically integrated up the financial, food chain, so to speak, to kind of move towards the owner's box in raising our own funds. So to us, travel and leisure was just the natural thing to focus on, because it's what we were passionate about. It's what we had always done. It goes back to what Terry Williams told me about combining vocation and avocation. And so that's what we did.
And so KSL, we're now 16 years since you and Mike started it. How big is KSL now?
So what
most recent fund?
Yeah, so I guess we grew from zero. We started with 5 people, and we raised $1 billion. I think we said
your first fund was $1 billion.
First fund was $1 billion. We said
those are some good relationships with those institutions.
It was, yeah. No, we were very fortunate, and we decided if we could raise $400 million, if we thought we could raise $400 million, we would raise the fund. We thought we could. We ended up being convinced by an outside advisor to target 750, not 400. And we had a hard cap of $1 billion, and we hit it. Which, I tend to think in life, if sometimes you're better off not knowing how daunting something is. Mm-hmm. I mean, today, if I were just advising someone in the same position, and they said I wanted to raise $1 billion first-time fund, I would say, boy, that's really, really hard. I don't know if you should do that,
right?
And we didn't know what we didn't know, and we were very fortunate. And today, if you think about growth, we went from 5 people, now we have about 105. I think by the end of the year, we'll have 120, and we have about 15 billion kind of cumulative assets we've raised over time, and we have 35 different businesses we own today, and 50 or 60 different businesses that we lend to. We have a large lending operation now as well.
So let's predominantly focus on the side of those assets that you own, whether it's operating companies or actual assets. So on hospitality, it's been a tough run during the pandemic for hospitality assets. Yeah. So wind the clock back to sort of March of 2020.
Do we have to?
Yeah. Well, this conversation is very different today than it was back then.
Yeah.
But obviously heading into that, everything shuts down, and you all are, focused predominantly in a sector of the economy that basically was like, no one's traveling, no one's going anywhere. When I was last week with Bill Hornbuckle at MGM, he gave the stat that he went from 65,000 employees at MGM to 12 in the course of a couple months. So I'm assuming your portfolio companies just, hunkered in and locked down.
I've never seen something like it in my career. I hope I never see something like it again. Being solely focused on travel, we have about 100,000 employees, and more than 90% of those employees, including that's including all of our portfolio companies, of course, have had to sacrifice in some way. Temporary furlough, that Bill was referring to, salary reductions, hour reductions, whatever it might be, but 90% or more had financial hardship as a result of COVID, directly from because we had to cut back. We closed. 90% of our businesses were closed. We had a couple of businesses that were deemed essential. We own FBOs at airports and things that had to stay open to serve aviation. But 90% of what we did was closed in the second quarter of 2000. Never. We were operating assets, after 9/11 when flights shut down in Hawaii. No one's ever driven to Hawaii, as far as I know. And and basically we went from 90% occupancy to 9%. September of 2001 to October of 2001. It's hard to believe that tragedy was 20 years ago now. But we thought that was unconscionable when that would happen. Now, it came back quickly when flights started back up and people felt comfortable traveling again. But this, to go on the way it did and to be global, We now have businesses across the globe, and 90% of our businesses were all closed, and the employees were furloughed, and and had reduced compensation and various things. It's terrible. So it's remarkable. That time last year, understandably, we had people who were questioning whether we would survive. Right? And I didn't question that at the time, but I should have. Right? I mean, because you're kind of in a crisis mindset.
Back to, it's good to know what you don't know.
Yeah, sometimes right. Sometimes it's good not to know. And
I don't watch it, just as an aside to that, I don't watch our stock price. I stopped watching our stock price 4 years ago and only look at it.
It's done really well since then.
Thank you. And
in case you didn't know.
I'll only look at it 2 days after earnings.
Okay.
But what was super helpful was a year ago when our stock went from $75 a share to $25 a share. Yeah. I didn't watch it do that. Yeah. And other than a friend of mine in a private equity firm calling me when it was at $25 a share, asking if he could help. And I said to him, "Hey Chuck, calling me at $25 a share is not helping me."
Right.
But at the end of the day, that what you don't know often helps you a lot as it relates to, we were operating Walker Webcast as if we were going to continue to operate. And guess what? As you well know, our stock price had nothing to do with our ability to weather the storm. Right. And so it was good that I wasn't distracted by that, watching this, red arrow going down.
Yeah, it's important to be able to kind of maintain your view on kind of the horizon. Where am I trying to get to? Right. And if you just look at a step in front of you at times, right, it can be disorienting. And you can lose your way, right? I mean, it's easy. If I'm looking straight down, I can easily end up walking backwards without realizing it. Versus if I'm looking in the distance. So it was helpful, I think. Accidental probably, but helpful. And to think about where we are now, last year was about surviving, and this year now, we're thriving. Right? Now there's obviously some hiccups out there on the horizon with Delta and so forth. But it's been a remarkable. I've never been more proud of our teams, each one of our businesses, than how they too they soldiered on through COVID, and they were incredibly responsive to, protecting our people, protecting our liquidity, and protecting our ability to go on the offense.
And when was it, Eric, that you felt it shift from, if you will, defense to offense? Like, was there a moment where you either saw, I don't know, occupancy in an asset or returns coming back, where it was July of last year, it was October of last year, all of a sudden it's like, okay, we're not only going to survive this thing, it might be the opportunity for us to get on offense.
So it's interesting. So we never had a moment where we weren't on offense, at least to a degree. And so March 13th, plus or minus, we all shut down, right? Plus or minus a few days. And by the end of March, you started the Walker Webcast. we weren't savvy enough to do that, but we started kind of regular calls with our investors. Once a month, once every 6 weeks. My philosophy has always been, communication is really important. Most problems in the world stem from poor communication. But when things are bad, communication is like triply important. And so by the end of March, and to me, communicating outwardly forces you, like writing things down, forces you to kind of like get your act together and have a plan. And so we developed kind of a philosophy, very quickly, kind of by the end of March, that said, we have 3 protection priorities, the ones I just mentioned: protecting our people first, our liquidity second, and our future opportunities third. The first 2 were all about defense, and the third is about offense. And now, how much we weighted those in those beginning days, we were 85% defense, but we were still 15% offense. We were buying stocks, and we were buying debt securities, right, which had a temporary impact. Looking back, I wish we bought even more, but we invested $300 million in public equities, and probably not the similar amount in debt in public securities, kind of towards the bottom, March, April, May. And so we were always trying to balance defense and offense, because we knew from the past, we said, look, travel's resilient, leisure travel in particular is resilient. People will come back. And at the time, we thought that was going to be 3 to 4 years to get back to prior peak for leisure, and another couple of years beyond that for corporate. We moved those kind of planning cases in now a couple of years with the vaccine. But we started off with that defensive positioning. And I think we probably were still like 70, 80% defense probably up until the vaccine. And then I think we shifted to be 70 to 80% offense. Right? And today, we're probably 85% offense and 15% defense. I mean, I'm making up the numbers, of course, for direction.
And you have assets not only all over the globe, but you have what I would call urban infill hospitality, or hotels in big major cities in Nashville and Dallas and other cities that typically are focused on the business community. And then you have these destination resorts and beautiful places where people head away and hunker down. I'm assuming that's almost been a tale of two worlds, in the sense that the returns on those urban assets have been flailing since sort of the beginning of the pandemic and haven't fully recovered, and that your hospitality on destination resorts, you don't have enough rooms and you can push rents as high as you can possibly imagine. Talk about that a little bit.
Look, I think you're directionally right. The corporate recovery is definitely muted. We actually have seen signs. You look in the last, even the last month, we're probably back to circa 80% of 2019 levels in terms of booking activity for corporations, 70 to 80, and we were 90% or so pre-Delta. So it's gone down since Delta, but we were like 20% beginning of the year, right? So it's risen. Say 20 to 90, back to 60 or 70%. But directionally, you're right. I mean, you almost can't charge enough, and you can't have enough hotel rooms on the leisure side, especially drive-to leisure. And on the corporate side, I don't want to say you can't give the rooms away. It's better than that. That's certainly what it was, before February, March of this year. But it's definitely much weaker. Fortunately for us, we were positioned on the equity side of our business, 90% leisure going into COVID. Okay. And that was deliberate.
And have you found buying opportunities on the corporate side, in the sense of, have you sat there and said, okay, this isn't going to last forever. There's someone who wants to sell a hospitality asset at an 8 cap and we'll buy it?
Yeah. I mean, we've been very active buying select service hotels recently, as an example, kind of onesies and twosies, and aggregating them into a new platform we have called Mission Hill Hospitality. That's run by one of our former execs, Greg Canley. We're under LOI right now on a large portfolio of urban hotels in Europe. And so that's a place where people aren't chasing as much, right? On the leisure side, values are, they're back. They're above prior peak. We've actually announced a few exits recently that I certainly, a year ago I wouldn't have thought would happen until 23, and we'll close several transactions this year. On the corporate side, corporate travel will come back, right? This connection in person, right, is far better than doing it over Zoom, just like you started with. And people will realize that, and the competitive juices will flow. Once, someone who's doing sales, whatever business, right, they get a new client because they went to meet them in person, what's their competitor going to do? What's the other salesperson in their business going to do? Well, they're going to go travel too. And so it's just going to take more time. Corporate groups were even starting to come back this fall before Delta, right? They've now, fallen off, but it showed you that there's pent-up demand for people to get together. And if anything, remote work is going to increase traditional corporate travel, because in lieu of going to the office, businesses are going to bring people together for more off-sites and those types of things.
That's a really interesting thought. I hadn't heard that, and that makes perfect sense.
Yeah. So it's just going to take time. So we see there being more
to do something unique, not convene just because it's another day at the office.
Right. So we see opportunity in both sectors right now. Leisure is the only thing that stops us from investing in more leisure right now is price. And there's a little less competition, when you're doing smaller assets, when you're in some geographies that aren't quite as institutional, and also in corporate hotels.
So you also are an investor in, or you own Holiday and Vacations, the timeshare.
Vacation Club.
Vacation Club.
We're an investor in it. We don't control it.
So talk about that, because I am assuming I think there's something between $6 and $7 trillion of excess deposits in the U.S. banking system right now, and everyone is buying, as we both know, you can't buy a bicycle today, you can't buy a car today. Everyone's. I would assume that business has also benefited from people saying, "Hey, I'm going to spend more time with my family. I'm going to go vacation. I want to buy a timeshare."
It has. I mean, that business is that business. People are really, they're prepaying for future vacations, right? That's what it's about. It's not a real estate investment as much as it's investing in your vacation time, right? If I prepay for this vacation, we're going to use it, right? right? And it's easier for me to bring friends and family along because we've already bought it. So there's, you don't have the same tension of, where are we going? Are we splitting the bill? Et cetera, et cetera. So there's a lot of motivations for people to buy timeshare that are different than buying traditional second home real estate. And it's more affordable, but it's less of an investment per se. And what we see now, because of the high disposable income and high savings rates that you're referencing, is we've seen a return. The industry as a whole, and certainly Holiday and Club Vacations, which is the business we've invested in, has seen it too. A return of vacation activity, and then what comes with that is a return to touring vacation club properties, and then converting those tours into new members and upgrades of existing members. And people want to vacation more, so they upgrade. People want to pre-commit to their future vacations, so they buy a membership. And so we have seen that increase. Pre-Delta, there was a pretty material increase over 2019. And with Delta, the combination of Delta and hurricanes in the southeast and and those types of things, you've seen some impacts and noise in the numbers over the last month, but the industry is really quite healthy for the exact reasons you speculate.
So you've just gone under contract, I think, to sell apples.
Yes, Apple Leisure.
Apple Leisure. If you want to talk about Apple Leisure, talk about it. But the question I have from that is, you bought that business with KKR from Bain.
Yeah.
And so here we have 3 private equity firms, one that had had it for a period of time, 2 others come in. What is it in the private equity? I totally get that there's a company that needs private equity to get it, if you will, from point A to point B, to either go public or from point A to point B.
Why buy another sponsor's deal?
Exactly. Why buy another sponsor's deal?
What made us nervous, going into it made us nervous. We looked at it when Bain bought it, and unfortunately, we didn't buy it then because Bain did really well with it. So we would have loved to have owned it earlier even. But and my next door neighbor is a senior Bain exec, and so we chatted a little bit about this because I was nervous buying them. They're a very savvy investment firm, and we just felt that the trends around Americans, Canadians, and to a degree Europeans traveling to Mexico and the Caribbean, with the quality of the beaches, the environment, the service, the culture, was the value proposition from that travel was so strong that there were great tailwinds in the industry. And we had tried to buy a couple of other platforms in Mexico and the Caribbean. One of our partners, Rich Weissman, led this for us and did a great job. And what we kept upping up against is, now we thought that we like that platform. Maybe we didn't get there on price or whatever it was. We were learning about the business along the way. And what we kept on hearing was Apple are the best operators in the region. So if you do a deal with Apple, you should do a deal with Apple. But we had missed it with Bain. So it was already, it was gone. So when it came back around and Bain was selling it, in our minds, we knew that Apple was, we thought the best company, the best travel business in those regions. And so we were really tempted to buy it, and we had to get over you're buying from Bain. Right? And we just really felt that there was enough tailwinds, and the management team was really strong. We believed in the plan, and frankly, having our focus be solely travel and leisure, we bring something a little bit unique to the table that other investors who are very smart and successful, they don't have the same tie-ins with all the other businesses, the same perspective of the sector globally, perhaps. And so, we felt that we could add value. And one example of that was we were looking at buying a small hotel operator in Spain from our European office called Alua Hotels at the time. Great business. And, instead of buying it on a standalone basis, we ended up, Apple was like, look, we think that would make a lot of sense for us. We talked to them about it. We agreed. KKR agreed. So we merged it into Apple instead. And they now have 100 hotels, give or take, in the pipeline in Spain. And for Hyatt, who's now buying it as a strategic, right, they see the same thing that we saw, except now they see a bigger footprint. They see an expansion into Europe. They see multiple brands that they can continue to grow, and partnering with their World of Hyatt loyalty program. They see there being a tremendous synergy from that. And we had previously done a deal with Hyatt where they had bought Miraval Hotels or Miraval Spa from us, which is a kind of luxury spa operator. They're now rolling out. And so we had a really good relationship with their CEO, and that led to this transaction. So we were nervous about exactly what you asked, but we felt that there's more that we could bring to the table And I think the proof's been in the pudding because the exit was very successful for us. And I think, frankly, the business is going to be that much more successful for Hyatt, just like it was more successful for us than it was for Bain. I mean, they did phenomenally well, but we did well too, is what I mean. And, so I think you have to be careful when you buy another sponsor's deal, but it doesn't mean it's always the wrong thing to do.
You mentioned Spain. You have a bunch of assets over in Europe. You also have a number of assets down in Asia Pacific, in beautiful places like Maldives and Fiji and other places. How is that market done, given that high-end, you said, if you can drive there, it's done exceedingly well.
Yeah.
What happens when you need to get on a 14-hour flight to Hong Kong and transfer planes?
So it's interesting. It's all about cross-border restrictions. And so if you look at our assets in the Maldives, for example, we own Soneva Fushi, or we own part of Soneva Fushi and Soneva Chani, with a wonderful partner who founded that business. The Maldives opened for travel quite quickly. And by the nature of having one hotel on one island, which is kind of the way the Maldives generally works, and not dense at all, just spectacular locations, it was relatively easy to have a contained environment. All your employees are living on the island. You're testing everybody before they come onto the island. You're doing rigorous protocols while on island, both in terms of masking, social distancing, actually they did not do masking, social distancing and regular testing. They basically tried to create a COVID-free environment within each island. And it really worked. Most of the cases there have been in Mali, which is the capital. But on the individual island, it's really worked. And so what we actually saw was, our profit is going to be 2 to 3x in the Maldives this year what it was pre-COVID.
So 2021 versus 2019.
21 versus 19.
Yeah.
And it's because, look, it's a very unique
mix, Eric, as it relates to the clients. In other words, if it was 60% Americans and 40% other, does that stayed, or is that all more Asian customers?
It's the most internationally diverse market I've ever seen. So you have, China was the biggest market, and they're largely not traveling.
Right.
But you have Russians, Brits, Germans, Austrians, folks in the UAE and Middle East, Indians, Americans, and they're all kind of 5 to 10% markets. And so, and in our case, there's such unique properties. People were willing to do the long plane flight. And, because once they were there, and some people stayed for 3 months, so it's remarkable.
Sign me up for one of your resorts for 3 months in the Maldives. Me too. I can't wait for the day that I can go do that.
Unfortunately, my partner who leads that investment, he went to the Maldives from New York for a day, for 2 days. That's not the way to go. The 3 month thing, that's a much better way to do it.
Yeah. So while we're in
but enough of those markets were open,
right?
And the pull was so strong that we were able to offset the markets that were geographically close to us.
But so, for instance, you also are an investor in a company in New Zealand, which is this really cool kind of what looks like what's it called?
Baillie Lodges. It's Australia and New Zealand, actually, not Canada.
Amazing, but you can't get there, right?
No, you can't. So that's been more challenging, although interestingly, there's such a strong outbound tourism market from Australia and New Zealand that since they can't leave, they're doing more staycations. So once the Tasman bubble opened and once their lockdown stopped, now they go up and down. There was a lot of desire for people to explore their own country. So we benefited from that, but no, net it's been challenging there. Same thing with Canada. When the borders are closed and you run an international business, it's a problem. So we're, fortunately, we don't have too much of that, but I'm confident that when the border opens there, and I hope it's soon, but it might not be for a year, the pent-up demand to travel to Australia and New Zealand will be off the charts. And so we've actually been acquiring and adding properties, protecting our opportunity set. We've been adding to our collection of properties in Australia and New Zealand during this time period.
And you also have a cruise company down there.
Formerly did, yeah.
Oh, formerly, so you're out of
that. We're out of that.
Okay,
Yeah,
so I'm assuming you're happy to be out of the cruise business right now.
I think probably that would have been probably the only business in the world that would have been maybe more stressful than what we have. But even there, I think, look, bookings for cruise in 22 were really strong. People rebooked from what they canceled in 2021. It will come back. There's a very compelling value proposition to cruising. The convenience of seeing multiple ports, especially with an aging population, is pretty overpowering. Yeah. I was probably happy not to deal with the stress of having a cruise line over the last couple of years.
So you've invested in a couple of what I would call emerging concepts in the hospitality space. One is open canvas.
Under canvas.
Under canvas.
Yeah.
I guess you're probably happy that it's under canvas and not open canvas. Although some of the ones that I looked at do actually have these wonderful.
They have skylights.
They have skylights in them, and you look up at the stars. They're in really neat places like Moab and other really remote places. I'm assuming that's been did that come about just because of the pandemic, or were you already there before?
No, that's probably blind luck. But I mean, there's probably no better travel business during COVID than national park oriented glamping resorts.
Yeah.
Right. I mean, you're in your tent, you're spread out from people. These are kind of, a lot of people are doing road trips. People were driving 20 hours. Right? People used to fly from Chicago to Moab, or Yellowstone. We're now driving during COVID. But the value proposition was so strong. I've never seen this in my life where we lost literally all of our bookings between March and May of last year. Just really a summer seasonal business primarily. We lost all of our bookings. We thought we were going to have a great summer. We thought we had nothing, and we thought the business was worth 30 cents on the dollar. At the time, we were scared about it. They thought it might be terrible, and then we saw people starting to drive and book, in June, and we had record profitability last year, and then this year we've had record profitability again, and we added 2 new camps this year, and now we're at kind of triple the levels of EBITDA we were pre-COVID. We've added 20% new units. We're going to add 20% next year and probably continue that growth. We just actually sold a small minority stake in it, at a very attractive value. A remarkable turnaround. It's an amazing experience. For those who, my family knows I'm not a camper by training or by background, but this is camping I would do.
Yeah.
We've got some ultra luxury glamping sites in Baillie Lodges actually in Australia and Canada. This is kind of a really great experience, but it's not ultra luxury. The price point's much more attainable. But it's $400.
Yeah.
It's just look.
I was doing research on it. I was like, I'm taking the family in Moab.
We're adding a second camp in Moab.
I'm assuming you can't even get a reservation, even if I call them up and tell them I'm a friend of yours.
Well, that won't help. That doesn't help anywhere. But I can introduce you to some people who can probably help you out. But we're adding a second camp in Moab and a new one in Bryce next year.
Yeah, I saw the Bryce Canyon.
Yeah, Utah's a wonderful vacation destination. And so we've expanded. I think we will have 5 sites there next year.
So you also are an investor in health clubs, both in the UK as well as in the States. In the States, you've got an investment in Bay Clubs out in California.
Used to. Now we're a lender, but we used to own it.
Okay. What's your take on that whole sort of health club fitness as we've now, obviously lockdown, everyone buys their Peloton surges. Now all of a sudden, I was actually talking to my friend Brahma Grady, who runs Lifetime Fitness this past weekend. He's, weathered the storm and thinks that there's an opportunity now for Lifetime to go and really surge forward. Yeah. What's your take on the at-home versus club fitness space and what KSL is looking for investments?
So we've surveyed this a lot. We do a lot of kind of proprietary customer research in our sectors, and we made 2 fitness investments this year. We made a large investment into the largest franchisee of Orange Theory locations, and we bought a controlling interest in a company called Third Space, which is I would say the highest end health clubs in London, and then we own a fitness business that's integrated into a hotel business called Village Hotels that have their own fitness clubs with 100,000 members across the UK, and then the one you referenced, the Bay Club company in the Bay Area. We look at fitness. Look, the surge at home fitness is not going to go away, but for most people, that doesn't take the place of joining a gym. Just like for most people, going and doing Orange Theory or using ClassPass to do different classes doesn't take the place of a gym. It tends to supplement each other. There are examples where there's cannibalization, but the available market's still pretty large for fitness. We're back. Depends on where we are now in our businesses, but we're back to 70 to 90% of prior peak membership levels in our fitness businesses. And so we feel really good that it's a core part of people's lifestyle. Working out on Peloton's great. It's lonely working out in your home gym all the time.
Oh yeah.
Most people, I tend to work out in my own home gym, but most people want the social aspect. I'm probably more embarrassed to work out around others. Most people get energized by the social aspect of being in a gym environment or a class environment. So our thesis is it will come back. It will just take a little longer. It's a little bit more like corporate travel. They'll be there, but it'll just take a little longer. They'll come back quicker than corporate travel overall, but it's not like under canvas in terms of the drive to leisure. But we think that industry is not going to go the way the buggy went. Right. We think that the strong concepts, right? The Baker Company, Lifetime, frankly, right? Orange Theory, Third Space in London, Equinox in New York City. We think those concepts they'll be strong. They will come back strong. Will they have distress? It's a question of what their capital structure is, because a lot of them are still losing money.
Right. Two other retail concepts that you've invested in recently. One is a restaurant business based out of Austin, Texas, and the other is Dry Bar.
Yeah.
Talk to me about Dry Bar and going to the beauty salon, because obviously that shut down during the pandemic.
Yeah.
Are you seeing just an incredible resurgence of women wanting to go and get their hair done and hanging out in Dry Bar? But I don't understand the Dry Bar concept versus just going to a beauty salon. Is there something unique about being at a Dry Bar?
You've got good hair, Willie. Yeah. I mean, I think you'd be a good customer for us. Admittedly, you're not our core demographic, but it tends to be 90% plus women. So we have a business called WellBiz, which is it's a multi-franchise business company that focuses on health and wellness, or health, beauty, and wellness. So we're the franchisor, and then we're the master franchisor, and then building out these brands. So Dry Bar was one that we recently bought. We bought a wax business. We have an eyelash extension business. We have a day spa business, and we have a personal training studio business, all within that company. And so we're trying to add kind of leading brands in health, beauty, and wellness, because we see the trends toward investing in yourself, right, whether it be on the fitness side or the beauty side, are so strong. The tailwinds in that sector are so strong. Now, Dry Bar, we had a unique opportunity there. The business was about the hair dryers, and the business was about the salons, right? And they had a great product on the salons. They had a great hair dryer product. They sold that to a third party. And then they had a bit of a subscale business remaining on the Dry Bars themselves, which were actually what created the kind of energy around the brand, but it was hard to run that on a standalone basis. So putting that into WellBiz made a lot of sense. And what we see there is it's a bet for us, an investment on the resurgence of people doing events and people going to the office. And they have a great model where you come, it's relaxing, it's fun, it's social, have a glass of champagne, have a blowout. I mean, I'm sure my team is watching and laughing at me describing this business right now.
I'm impressed that you
please don't ask about any of the other beauty businesses. This is as far as I can go. But it's a social experience. And what we see overall is people are less and less about material things in their life, and they're more about experiences, right? And Dry Bar made an experience out of getting your hair done, right? It's not just going to a salon and having your hair cut. It's a social experience as well. You go with a group of friends before you go to, an event. Now, the business hasn't rebounded as strongly as like our massage business, and some of our other franchise businesses, because people aren't going to events and the office in scale yet, right? But even Dry Bar, we're back within spitting distance of kind of pre-COVID levels, and our other franchise businesses in the aggregate are up kind of 10% over pre-COVID levels. So we know it will come, and and we think it's a brand that can expand globally. It's a great concept. My 2 daughters, 18 to 20, and my wife, they really enjoy it. Like you, I'm probably not the customer, but but it's a great business. It fits really well within our strategy.
So I say what I, at least in my world, best for last, which is skiing, because you and I both love skiing, and you all bought Alterra. Well, you bought InterWest a number of years ago and then rebranded Alterra, and you're now the second largest ski operator in the world. Skiing 2020, 2021 ski season was a real challenge as it relates to how many people go on the mountain, how are we going to social distance, how do you do the passes, all that kind of stuff. I'm assuming the outlook the winter 2021-2022 is looking fantastic because everyone wants to be outside. And last winter was a huge success, correct? I mean, all things considered.
Yeah, all things considered, last winter was a huge success. You had the fifth most skier visits in history last year, which is pretty remarkable. The drive-through visits were way up. The destination visits were down. Those do tend to be the more profitable ones. So, I mean, it's not that everyone had record profitability, but, I live in the mountains, and what an incredible gift during COVID to be able to be out on a mountain, put aside whether you're wearing a mask in the lift line and on the lift, and the restaurants are, limited and all those things. To be on the mountain last year was the best gift that I think anyone could have. And so there's tremendous momentum going into the ski season. Look, I had hoped we would be completely done with, everything, all things COVID by now, but we're not. Hopefully we get there. I think you'll see less impact this year in terms of the restrictions, reservations. They may not be non-existent, but they'll be much less. Restaurants, I think, will be much more open in a traditional manner. Yes, you'll probably still be wearing masks when you're not at your table, I'm guessing. I think what we learned how to operate last year, and it was a little bit trial by fire. This year, it'll be much more well-honed. I think, frankly, the bigger challenge for our industry is not demand right now for skiing or other businesses. It's labor. Right? I mean, it's hard to hire people. Right. But I suspect that will ease as we come into the winter as well. So, I'm very bullish about what the ski season holds.
When we did our summer conference up in Sun Valley this summer, they came to me at the beginning where we had 400 people come out, and they said, just, kind of be patient with us because we typically have 300 summer employees on JV season. We couldn't get them in. We only have 40. And so they were down by 260 people at Sun Valley this summer. Yeah. And so at the beginning of the conference, I said to everyone, if your room service doesn't arrive exactly on time, just take a deep breath. We are trying to kind of dig out of this.
Yeah, I think last year especially, people were they were so happy just to be able to go outside and to do these activities, whether it was going golfing or skiing or visiting going glamping or whatever it might be. They were very accepting and patient. I sense we're becoming a little less patient now. I hope that we can maintain that patience because we're going to need it for a little while longer.
Talk about Icon versus Epic, because clearly the two major operators and owners of real scale, you have 28 resorts?
We own 15 and we have about 45 in the network.
Okay.
We just added like Kitzbühel and Cortina in Europe.
Oh, that's neat. But here in the U.S., the Icon Pass and the Epic Pass have really, from an outsider's perspective, really consolidated Alterra and Vail as the two major players in this kind of competition between the two of, right? I mean, in my family, it's always a debate about, are we doing Icon or are we doing Epic?
I'm not I fear of hearing the wrong
So I actually get a pass on this because you're on the board of the U.S. ski. You're on the board of the U.S. ski team, and I actually get a gold pass from the U.S. ski team. So I get to be in your good graces because I donate to the U.S. ski team to get a gold pass.
And we appreciate that.
Yeah, but on that, it sort of changed the whole nature of the ski industry. It used to be like, let's charge, little for the season pass and a lot for the day pass because we want to kind of gouge the day person. And now it's completely shifted to let's get them bought into a long-term pass because we're going to keep getting them coming back. And so it's almost like you can't get a day pass to go ski at one of these places. You almost have to be a member of either Icon or Epic. I see the look on your face that says to me, I'm not.
I think directionally, certainly like the pricing model of the day ticket versus the season pass, it very much encourages people to get a season pass. I like the word you use, say member, right? And I actually kind of think of it that way. Like, you're joining a network, right? You can join the Icon network, you can join the Epic network, you can do some other, smaller networks and things out there, or join an individual resort. The sport overall is healthy, even though Icon and Epic, they're helping grow the sport. And yes, they have a very meaningful presence and so forth, but by no means are they the only alternatives for people. But I think of it as a membership in the sense of like, what network do I want to associate with? And the nice thing now is the anticipation of planning a ski trip is exciting. So often people come up to me like, I'm looking at like the website, I'm seeing all the resorts on Icon, and you just added Kitzbühel and Cortina and Ski Dolomiti, and I'm thinking like maybe I can do this one or that one, and I'm going to add a trip there to go that one. Like that anticipation, right, is part of the value of buying the pass. And gone is the stress of, well, I'm going to book, I'm going to commit to this one place. I hope they have a good snow year. I mean, somewhere within the Icon network, somewhere within the Epic network, there's going to be plenty of snow, right? You're pre-committing early. And my view is if you self-identify as a skier, which many of us do, then hopefully the next thing you're asking is, well, what network do I want to be part of? And a not inconsequential number of people, they choose all of the above. They actually buy an Epic and an Icon, right? Which, great. I think that's wonderful.
But the cost of a season pass now actually has come down so much that you can get two for the price of one, basically, from when you all gone.
I moved to Vail. I mentioned I graduated school in December. I graduated because I ran out of money for college, and I didn't want to take on loans and those things. And I thought, when would I have a chance to live in the mountains? And so I moved to Vail for that semester. I was wrong. I'd have a chance to live in the mountains in the future. But, I bought a season pass for $1,100, and it was restricted. Right? No peak days and those things. For $1,100, give or take, buying early, you could buy probably the entry-level product for both Epic and Icon. Not inconsequentially different, and that's nearly 30 years ago. I mean, it is a lot more affordable. Now, lots of things around skiing are still expensive, don't get me wrong, but the actual lift ticket, buying a pass, is now quite reasonable, certainly relative to what it once was, and provides a tremendous value.
So the future value of Alterra has a lot to do with the environment, and you and I have both spent the summer moving from one mountain town/city to another with a lot of smoke.
Yeah.
We've had massive forest fires out in California and Oregon.
Yeah.
Fortunately, Townwood, not in Colorado. But the amount of snow we're getting, the amount of rain that we're getting is all kind of headed in the wrong direction.
Yeah.
Are you all doing anything specifically on those issues as it relates to trying to make a dent?
So we're trying to be a good corporate citizen, right, around our portfolio. It takes different forms in different places. Soneva in the Maldives, we literally issue an 80-page, basically environmental P&L each year, where they're completely carbon neutral, and they've got a wonderful program where they're like recycling all the glass into art, and then they're using that art in the property and they're selling that art to customers. They're doing the same thing with other recyclable materials. They're offsetting their carbon usage by buying, converting wood stoves to gas stoves in Sudan. They're probably the furthest ahead of any other place I've seen in the world. It's a real part of their ethos, and people go there in part because they really respect their environmental statement. I think within skiing, I think our partners in Alterra, Aspen, are kind of the industry leaders, I think, within this. In terms of being creative in their energy sources and commitment to becoming carbon neutral. We're at Alterra, we're still in the formation stages of this business. It's been 3-4 years now. So we're doing what we can in terms of energy efficiency, looking at the more efficient forms of snowmaking, trying to be responsible. We have more we can do, and we need to, right? In all of our hotels, we have initiatives throughout our business, not at Alterra, but more broadly. Similar, looking at how do we minimize our carbon footprint? How do we make that part of our ethos? And now the nice thing is, it's not just about it being the right thing for the environment. That's motivating enough, should be. But it's also about resonating with our customers, because that's now become important to our customers. And when you'll get businesses to really move, they'll move from being a good corporate citizen to some degree. They'll really move when they think it's in their self-interest. This is now writ large. I like to think that we'd be better, but I'm sure we have our own challenges. But when you start to realize that, hey, actually my customers want this, my employees want this, my communities want this, now all of a sudden you realize I need to do this not just because it's the right thing to do for the world, it's also the right thing for my business. And I think we're in an evolution, as are a lot of companies. It's been a train wreck, obviously. I've been involved in leisure or travel for the last 18 months. So I'd be lying if I said that we were able to devote the right amount of attention to this in the middle of COVID. We haven't. But I think the trend you're going to see for us and for our industry overall is more and more focus on sustainable practices, sustainable development. And it's not just, and it's for us and it's for our guests. So I think we're going to make a lot of progress, but all of us have to do our part.
So I'm super appreciative of the time and focus that you've given to this. It has been a real pleasure to sit down face to face and actually do this. To everyone who joined our conversation today, thank you so much for dialing in. Thank you, Eric. It was great. Really enjoyed it.
Thank you.
And we'll be back next week with another Walker Webcast.